Well, hello, everybody. Welcome to this week's edition of Market Insights. Steven Sitkowski here. Let me go ahead and share my screen with all of you. Hope you've had a fantastic week. Great Easter. Got to spend time with family and friends. You know, all the neat things about holidays. Want you to know that what we do here is for educational and informational purposes only, not intended as investment advice. So let's move in the markets. Well, we're trying to rebound from last week's losses, a little better than 2% on the week, predominantly due to the fact that we had some really strong jobs numbers come out, which on the surface appear to be inflationary. You know, the logic is if everybody's working, wages are going up, people are making money, they're spending money, that's going to cause inflation to rise. Hence, the Fed will be more reluctant to cut interest rates. There's your logic. Job gains cause rates to climb. So far today, now still early in the day, markets have responded fairly well, as they did at the end of last week. All eyes will be on Wednesday's CPI reports. That's the next big data point. I don't think it's as important as PCE, personal consumption expenditures, in the eyes of the Fed, but it is still a number that they definitely talk about. 10-year Treasury is now up to 4.414, getting above 4.5 could be a little problematic for the market, so we'll want to keep an eye on that. And oil is pretty steady at 86.43. So what to watch this week? We got some Fed speak today. Nothing of note on Tuesday. Wednesday, there's your CPI number. So that'll come out at 8:30 Eastern, and core CPI and year-over-year CPI. So that'll be kind of a big deal. Their Fed speak's not going to matter. On Thursday, we get the next round of initial jobless claims, producer price index, PPI. This is inflation at the wholesale level. Some more Fed speak, and then more Fed speak on Friday. So kind of a light week outside of CPI and PPI, which of course, pretty important stuff. Here's last week's heat map. Meta was our big winner. Amazon did well. GE, great week. Caterpillar, UPS, ExxonMobil. I'm doing covered calls on ExxonMobil right now. Have a trade on Meta and Amazon. I'm doing covered calls on Amazon. So it's a good week if you know how to pick the right stocks. Here's your 1-year heat map. So over the last year, there's been a ton of money to have been made. Again, if you're a good stock picker, Lilly up more than 100%, Meta 150, Google, now Alphabet 50%, Amazon 84%, NVIDIA, the big winner, 224, Microsoft 50%, Broadcom 110. So knowing what to be in is what it's all about. All right, market breadth. So I always like to look at new highs versus new lows. On the NYSE, 102 new highs compared to 31 new lows. Very bullish. On the NASDAQ, 79 highs compared to 143 new lows. Kind of a bifurcated report here. So that's not nearly as encouraging. But, you know, the market's been given back a little bit lately. Looks like everybody wants in inflows of U.S. stocks. It's the highest since 2021. Look at all the money flowing into stocks, as it should be. T-bills no longer in demand. So as interest rates have fallen, people come up for renewal. The demand for T-bills has gone down, but now that interest rates are moving a bit higher, that could reverse course. That's not good for the stock market. We like when interest in T-bills is falling. That market flows into equities. Markets are definitely top heavy. So market cap of the largest stock relative to the 75th percentile stock, way high. Now, is that a problem? I don't know. My attitude has always been, as long as Michael Jordan's hitting his jump shots, keep feeding him the ball. I swear that guy could still hit jump shots if he wanted to. Momentum stocks are definitely pricey. So those that have been running for a while, I gave you their names, they're clearly a bit expensive. Since the Fed's pivot, wealth has increased 13.5 trillion. That's just since November of last year. People have made 10.9 trillion in the stock market. Did you get your share? And 2.6 trillion in the bond market. Companies adding new employees, 303,000 last month. It's great for all of us that there's plenty of jobs, but it's probably going to put the Fed on pause. Wage growth has been slowing. So, what companies are willing to pay, they're hiring people, but the wages aren't increasing the way they were before. So 4.1 after tax, let's call it 3. Inflation's more than that. You better have something else going on. This is interesting. Young people now are the ones who are really focused on the economy going into this election. Pretty interesting. They are the biggest respondents of, I'm looking at economic issues. And that's because young people didn't have the reserves to fall back on, and they're concerned about what's going on and escalating prices. I don't blame them. Cost of retirement. So there was a survey done by Schwab. The average respondent said it's going to take 1.46 million to retire. The average person's got 88,000. Now in 2021, they had almost 100,000. Can't outspend your earnings. And cost of retirement is different perceptionally, depending on the age group. So if you talk to high net worth people, we'll tell you, you need 4 million to retire. And by the way, those are people that only have on average 172,000 saved. But that's considered high net worth on a relative basis. Baby boomers are saying they can get by with 1 million, and the rest of them about 1.5 million. So the earlier you start, the easier it gets. If you start at 20, you can get to the finish line, putting away less than $400 a month. If you wait until you're 50, $4,500 a month to get you where you want to be. Margins are expected to rebound. These are profit margins. Good news for the market. And Fed probabilities of a cut continue to drop, as I have shared with you. So there's about a 98% chance no change May 1st. And now there's about a 50-50. I remember when it was virtually a certainty that in June rates would be cut. I kept telling you, not as long as the economy stays this odd. And unfortunately, it looks like I'm going to be right. I have been saying July is a month. Doesn't mean that that's what's going to happen, but that is my best educated guess. 1 year returns. For the last 12 months, communication leads at 49%, tech 44.5%, financials, discretionary are right there at 30%, industrials doing well, materials at 16%, energy at 14%, healthcare is down to 7% for the last year. S&P for last year is up almost 30%. So REITs are way down. Staples haven't done a thing, and utilities have lost money. Take a look at the charts. See what they tell us. When in doubt, always check the charts. Here's the S&P 500. It's a great looking chart. Since we've crossed above the 50-day moving average on November 2nd, we've just climbed and climbed and climbed. There's some pullbacks, but that's just the nature of the game. But I look at this 50-day moving average, that yellow line, it is sloping up, and we're still trading well clear of it. Both of those are bullish. How about on the Qs? Sitting right on that 50 days, across below the 50-day for a couple of days, would give us cause for concern. So far, we're okay. We've been using that as a support level. And how about small cap IWM? This is the Russell 2000. Again, kept bouncing off the 50-day, and it's done so again. So all in all, things are looking pretty good. Keep an eye on that CPI and PPI number. That is going to have some real impact on the market. All right. I will be seeing you again next week. Until then, be blessed. Bye for now.